Okay, let's break this down like you're five, or just financially confused like the rest of us. Stocks. When you buy a stock, you're literally buying a piece of a company, not metaphorically. You're a part owner. It doesn't matter if it's Apple or Bob's Tofu Emporium. If they issue shares and you own one, congratulations. You technically own a slice of the business. If the company does well, makes money, and grows, your share becomes more valuable. You can sell it later for profit. If they crash and burn, you're along for the ride, except you don't get a parachute. You just get to watch your investment disappear. Welcome to capitalism. Bonds. You're the bank. You lend your money to a government or a company, and they promise to pay you back with interest eventually. It's like giving your buddy $1,000 and he says, cool, I'll give it back to you in 10 years plus 3% a year. Expect your buddy is the US government or worse, a barely solvent corporation. Bonds are less risky than stocks because you're first in line if things go tits up. But don't get too excited. That's like being the first person on the Titanic to hit a lifeboat. Still a mess. The return is lower, but steadier. You're not riding any roller coasters. You're not hitting jackpot. You're just slowly earning interest year after year. Safe, dull, and mostly drama free. Think of it as missionary position investing. Predictable, uninspired, won't keep you up at night, but hey, it gets the job done. Especially if you're closer to retirement and the idea of losing half your money gives you heart palpitations. Mutual funds. This is a bunch of investors give their money to a fund manager who picks stocks for you. Sounds fancy until you realize you're paying 1 to 2% in fees every single year. That's like tipping your Uber driver 20% every minute they drive, even if they're going the wrong way. Because keep in mind, even when the fund goes down, you still pay the fee. Mutual funds are bundles of stocks or bonds picked by a so called expert. They're literally 1 to 2% annually for the service. And that sounds small until you realize over 30 years that fee can eat up over half of your investment growth. Let's say you earn $100,000 and earn 10% return annually. With no fees, after 30 years, you have $1.75 million. With a 2% fee, you only have just over $1 million. That's over $500,000 lost just for hiring a dude who probably hasn't beaten the market more than 2 years in a row. ETFs are also called exchange traded funds. They're the Costco of investing, cheap, reliable, and you can buy a bit of everything. Think of ETFs like a big ass investing smoothie. You throw in a bunch of stocks, hundreds or even thousands, blend them all together, and instead of trying to guess which fruit is the best, you drink the whole thing. No stress, no guessing, no gambling whether Apple or Amazon is going to have a better Tuesday. Like mutual funds, ETFs bundle a bunch of assets together. But unlike mutual funds, ETFs are traded on the stock exchange, just like individual stocks. You can buy or sell them instantly during market hours without having to wait for some fund manager to process it after their golf game. The big win is low fees. We're talking 0.03% to 0.15% in many cases. That's $3 to $15 per year on every 10,000 you invest. That's less than what you tip a bad bartender. Compare that to mutual funds charging 1 or 2%. That's $150 to $200 a year for every 10 grand, just for a suit to tell you that now is a good time to buy tech stocks. Nope. ETFs don't try to beat the market, they just match it. And guess what? The market wins most of the time. Over a 20-year period, over 85% of active fund managers underperform the market. That's like 9 out of 10 experts failing at the job they're paid six figures to do. So instead of picking stocks or trusting Chad and Finance to diversify your risk profile, you can just buy something like VTI in the US market or VUN in the Canadian market and get exposure to the entire US stock market. Boom, done. It's diversified, meaning your eggs aren't all in one basket, unless that basket is the global economy, in which case, if it collapses, your stocks won't matter because we'll all be trading canned beans for gasoline. It's efficient. You don't pay capital gains tax inside the ETF until you sell it. And it's passive. No staring at charts or pretending you know what the Fed's going to do next. You set it, forget it, and let compounding do the dirty work. The bottom line, ETFs are a lazy person's path to wealth. And that's not an insult. It's smart because the harder most people try in the stock market, the worse they do. So skip the stress, skip the fees, skip the wannabe wolves of Wall Street and just buy the damn ETF. Index funds. These are ETF's chill cousin. They don't try to beat the market, they just are the market. The S&P 500, that's 500 of the biggest US companies, probably the biggest in the world. You buy one index fund and boom, you own all of them. Apple, Amazon, McDonald's, whatever. Even if you hate them, you profit from them. It's capitalism with a side of passive income. Both index funds and ETFs usually track the same stuff, like the S&P 500, the TSX, or some niche like clean energy or emerging markets, but they go about it differently. ETFs trade like stocks. You buy and sell them throughout the day on an exchange. You can watch the price jump around like your crypto bro's mood, saving and place orders in real time. Index funds only trade once per day at the end of the market. You put in your order during the day, but you don't know the exact price until the market closes. It's like ordering food and finding out what you paid for after you eat it. ETFs, well, you can buy just one share or even fractions depending on your broker. So if a share of VOO is $450, that's all you need. Index funds, some have minimums like $1,000 or more, especially US ones like VFIAX. And here's the kicker: almost nobody beats the market long term, even the so called experts. Your picking stocks on a lunch break doesn't stand a chance against an algorithm that trades 40,000 times a second. Index funds have fees as low as 0.03%. That's basically free. Meanwhile, mutual funds and fancy stock picking bros are charging you like they're running a hedge fund for billionaires, but you still have a student loan and shop at Aldi. One proof? Warren Buffett, literally god of stocks, told his family to put their money in index funds when he dies. Not Tesla, not crypto, not GameStop, index funds. So unless you enjoy gambling, sweating, and explaining to your partner why you sold your savings for a hot tip from Reddit, just buy a broad market index fund and chill. The truth about stock picking: sure, you could pick your own stocks, buy a few shares of Tesla, gamble on some hot AI startup. Maybe you nail it, maybe you end up crying into your ramen. Let's be real, you're not Warren Buffett, you're not Michael Burry. You're probably just a guy who watched a YouTube video titled, "This one stock will be up 100 times by Tuesday." Even the pros get it wrong. A 20-year study showed over 85% of active fund managers underperformed the market. So what makes you think your side hustle investing while sitting on the toilet is going to beat the S&P 500? It's not sexy, but neither has been broke. What did Warren Buffett say? Be fearful when others are greedy, and be greedy when others are fearful. Translation: when people are panic selling, you should be buying like it's Black Friday. Time in the market beats the market, which means stop trying to guess the perfect entry point. Just get in, stay in, don't flinch. And most importantly, when asked what his own family should do with his fortune after he dies, put 90% in low-cost S&P 500 index fund and 10% in short-term bonds. That's it. No stock picking, no hedge funds, just boring old index funds. Why individual stocks are like Tinder dates? Well, they're fun at first, probably a disaster. So you think you're going to be the next Warren Buffett by picking the next Tesla, yeah? Cool. Just like everyone thinks their one-night stand is going to turn into a soulmate. Let's look at the reality. The top 10 stocks are always changing. You know the top 10 companies in the world right now? Apple, Microsoft, Amazon, Tesla, Nvidia, etc. You think you're doing well because you made some money off Nvidia or Tesla in the last few months or last 2 years? This isn't sustainable. You know who some of the top companies used to be around the time of the dot-com bubble in 2000? Yeah, Microsoft, GE or General Electric, Cisco, Walmart, Exxon, Intel, Royal Dutch Shell, Pfizer, Nokia. Guess how many of those are still in the top 10? Just one. You guessed it, Microsoft. Some other top companies at the time don't even exist anymore. Lucent was absorbed, AIG became a poster child of the 2008 crash, and Cisco stock never even came close to hitting the 2000 peak again, 2 decades later. So unless that crystal ball works better than 99% of professionals with 6 Bloomberg monitors and an Adderall prescription, good luck. What about all the dead or dying stocks now that you definitely would have bought in 2001? What about Nokia, the phone everyone had before iPhones existed? Now it's just mostly vibes and old memes. Pets.com, ever heard of this one? They sold dog food online with a sock puppet mascot, burned millions, went bankrupt faster than your last situationship. AIG helped blow up the economy in 2008, got bailed out, but not before nuking investors' portfolios. Blockbuster said no thanks to buying Netflix. Now there's one left and it's a tourist attraction. BlackBerry, once a corporate power phone. Now it's for dads who still think physical keyboards are cool. Sears used to sell actual houses in a catalogue. Now it's selling nostalgia and sadness. Enron, accounting so creative they would have won an Oscar. It imploded, took people's retirements with it. MySpace, technically not a stock, but worth mentioning because Tom is still everyone's first friend in financial failure. Yahoo turned down buying Google twice. Enough said. Kodak invented the digital camera, then forgot to use it. Remember all these? These could be today's hot stocks. Today's hot stock is tomorrow's trivia question. Why gamble picking winners when you can just buy everything with an index fund and let the market do the weeding? It's like betting on the winning horse in a race, or just owning the whole damn stable. One shits the bed, the other keeps running. Although it's very difficult, the market can be beaten. Every year, some managers boast better numbers than the market indices. A small fraction even manages to do so over a long period of time. Over the horizon of the last 20 years, less than 10% of US actively managed funds have beaten the market. That's about as rare as a vegan at a Texas barbecue. Fidelity did a famous internal study years ago to see which clients performed the best over the long term. Who were the top performers? People who forgot they had accounts and people who were dead. Why? Because they didn't mess with their investments. They didn't panic sell during a crash. They didn't chase meme stocks. They just sat there, compounding in peace. ETFs and index funds, the boring heroes. They don't try to beat the market, they are the market. They own hundreds or thousands of companies. The fees are dirt cheap. You pay 0.03% to 0.1% in many cases versus 1 to 2% with active funds. The conclusion is be boring and win. Buying individual stocks is like trying to win a knife fight blindfolded. It's sexy, it's exciting, but chances are you're going to bleed cash and end up crying into your Robinhood app. Just buy a low-cost index fund like BTI or VOO and let time and compounding do the heavy lifting. If you want to gamble, go to Vegas. At least they give you free drinks while you lose money. What are the final thoughts on this? Well, if you want to invest, not gamble, then buy low-fee index funds or ETFs. Do I need to say it again? Put them on autopilot and stop checking your phone every 10 minutes, like it's Tinder for stocks. This stuff isn't rocket science, but if you screw up, you will retire eating beans and return watching reruns of Shark Tank, wondering where it all went wrong. Be boring, be consistent. And for the love of money, stop paying Wall Street bros to be mediocre. Subscribe if you want to learn more.